Today's guest on Around the Coin is Willie Pang, the CEO of Limepay. Limepay has raised over $30 million to help merchants, retailers, businesses offer buy now, pay later solutions. So when you go to a website and you want to buy a pair of jeans, they're the ones that allow you to spread that payment out over time instead of paying it all at once using a credit card. We talked about the buy now, pay later industry. We talked about how Limepay got its start. And then we also talked about the intersection of advertising and e-commerce and what the future may look like using cryptocurrency technology in buy now, pay later. We discussed briefly on the influences that social media apps like TikTok have in a geopolitical sense, and then wrapped up with our real take on the influences of the global economy. Hope you enjoy this dynamic, wide-ranging conversation. Here is Willie Pang. All right, Willie, I'm excited to chat with you, man. Maybe we'll kick it off with a bit about what you're working on. So with Limepay, just give me the quick story on how it began and maybe what led up to it and what you guys are doing.
Great. And Mike, thank you so much for having me. It's an incredible privilege. I think for us at Limepay, our business is really only 2 or 3 years young and started in 2018, essentially as I think as a combo buy now, pay later / payments company. And it's really, it's amazing how quickly the ecosystem has changed. And you will, I think listeners around the world will remember that, as Aussies, we are Sydney domiciled. We'd love to stake claim on, the afterpays of the world, having sort of brought BNPL to the masses all around the world. And we were looking at that model way back then and thinking to ourselves, hey, you know what, we think that the proposition of a brand or a merchant getting to the end of a very expensive customer experience or design of a customer experience to sell a product and then sending, Mike Townsend out to a third-party marketplace and losing customer ownership, we thought that the model was broken. And so we created Limepay essentially as a white label solution so that merchants at checkout could own the customer all the way through to the end of that purchase journey from a buy now, pay later, or what we now call pay in installments capability. And that was really the genesis of the business. And it's been a really interesting journey because over time, and we can see now, and I guess we'll talk about this more, Mike, is as consumer finance or B2B finance has changed, as embedded finance experiences and the way banks are kind of thinking about playing in this ecosystem, as all of that has changed, we too have changed what we do and how we play. And so I guess we can unpack that in a little bit more detail.
Yeah. So why it seemed like there was a lot of entrants in the market. So basically it's like you get to check out and instead of paying with your credit card, this concept, the buy now, pay later, allows people to split that payment up over months, maybe 6 months or a year, multiple years. But it's like instead of buying a couch for $1,000, you pay $10 a month for 12 months. So you pay a little more, but you get the benefit that you don't have to pay it all up front. And then money is made on the interest or the difference between what it would cost now versus over time. Did this kind of like industry pop up? Was the opportunity there from what you saw because of some technological or regulatory or cultural condition? Because it seems like that was when this kind of became popular.
Yeah, it's a great question. I mean, it's probably a combination of all of those things that you've just described, as it is in almost every sophisticated money market around the world. It started in sort of unregulated lending. That's why the paying for or the buy now, pay later is mostly in jurisdictions limited to, sort of 60 days, or here in Australia, it's a maximum of 62 days on the repayment. And so therefore you get to kind of the 4 equal installments or 8 installments or whatever it happens to be, but it tends to be within that space, and it really created a new way for consumers, because paying in installments, quite frankly, has existed since the 50s, right? When MasterCard and Visa and the banks and Bank of America, as an example, started this stuff. So it's actually fundamentally been around for a long time. But in allowing particularly younger consumers and customer cohorts to download an app in a very digital experience that looked like it was mostly free, and then to be able to use that credit that they had to deploy on their favorite e-commerce websites. I mean, that was just pure genius, right? And who doesn't like free money? I mean, the proposition, and this is Mike, we're big believers. In fact, I think most people, particularly retail banks around the world, are big believers in the opportunity. If you look at what FIS/WorldPay are forecasting for total installments, I mean, globally, it's sort of just north of $100 billion right now. By 2025, might be a little bit longer than that. By 2026, it'll be over $1 trillion.
So wait, what is that? What does that number represent? The amount of money totally in the world?
Total transactions that will be paying installments. So it'll be over $1 trillion. So there's an orders of magnitude growth opportunity in just the next short 3 years.
Interesting. And what's the genius part about this? Is it, yeah.
I think that as a consumer proposition, it's a total winner. It's a total winner because you and I, if you can, I think our fundamental view on it is responsible lending is important. Regulation in this part of the sector is important, and it will happen. And you can see it in the States and in the UK and in Australia and so forth. There's no getting around that. We actually think it's a good thing because what we also have seen in the sector is everyone's chasing after that $1 trillion. That doesn't mean you should be giving credit to everyone and anyone. And buy now, pay later, or paying in installments is a wonderful cash flow management tool. The operative word being management. If you know how to manage it, then it's very useful. If it's not, then you've got 7 apps on your phone and you're kind of just cycling, those old credit revolving. It's basically
yeah.
Right. But as a core proposition to help either consumers or businesses to manage cash flow better, we think it's a terrific solution, and it's proven, and that's why the growth is so
yeah. And so what changed there? You said that something was genius. Was it that the previous experience was you go to a website, you want to buy a mattress, the mattress website will redirect you to some banking page, and then you apply for credit through them, but it's like clunky. And then the genius part of it was that it's all in the same page, and it's like click a button, and it's fast and easy. And who was kind of the breakthrough company with that model?
Afterpay was probably, Afterpay and Klarna Affirm would be the three that but for us here in Australia, obviously having proximity to Afterpay, I mean, definitely the leader in creating that amazing consumer experience.
Interesting. And it's I'm trying to wrap my head around why it's such a big deal, or why it had been not developed sooner, because it seems like such a simple concept and something that would have been built in like 2000, maybe even like Web 1 PayPal days, or like early 2010, 12, 13. Was it the access to the data that like is Afterpay, Klarna, Limepay, are these companies using like cookies on sites and using more like web centric means of assessing somebody's credit, or are they still pulling like hard credit pulls to make those calls?
Still hard credit pulls. I mean, partially it'll be some with more availability of data, with easier kind of access to mobile downloads or app downloads and so forth, is, I guess, paved the way. I think they stumbled upon it in many ways. I feel like if you track back 5 or 7 years and we're asking merchants all around the world, is there anything broken? They probably would have said, hey, credit cards have been working for 40 years. Nothing's wrong with that. So it did take someone to come, which in many ways is a precursor to what we're seeing in embedded finance solutions right now across every sector, is it took someone like an Afterpay to come around and go, guys, I'm going to totally disrupt this what is the accepted consumer experience norm, and create something that's new. And now all of a sudden, every retail bank around the world is like, oh shit, I've got to, pardon the French, I've got to go and build new experiences.
Why would a retail bank, meaning like why would a retail bank need to do anything?
I think that the retail, well, there's a couple of things. One is the credit card issuing businesses. I mean, there's a reason why card schemes, and this is all public, and they, MasterCard and Visa doing some smart things around evolving how younger consumers are thinking about and using credit cards. And part of that is a recognition that buy now, pay later and the experiences that the Afterpay, Klarnas and Affirms have created is kind of shifting the way younger customers are thinking about consumer credit into the future. And so they too have programs that are trying to take advantage of this and transitioning from what was a credit card experience into a mobile wallet experience, right? So I guess everyone is reacting to that. And so retail banks, and for the same reason, as they think about what will happen to credit card issuing businesses as part of their business, they've got to evolve to build some
Right.
build some skill.
They're really the ones that feel the pinch as buy now, pay later market grows, credit cards decline. It's like roughly, I mean, it's probably zero sum, close to zero sum. I mean, maybe somebody's buying something that they wouldn't otherwise, but I'm sure it happens on the fringes. But majority is like moving transactions from credit card networks to buy now, pay later. And what prevents, tell me if this is happening now. Are people paying off credit cards using buy now, pay later? Does it make sense to do that? No.
No, it would work the other way. So folks are using credit cards to pay off buy now, pay later as an example. They're still running on all of the kind of historical payment rails, right? So the credit card becomes a way of funding the buy now, pay installment.
Oh, and what happens if, I'm not sure if this varies by company in the space, but what happens if somebody doesn't pay the installment, like they miss a monthly payment? Is there just, with a credit card, you don't pay and then they attach a fee onto the late payment? Is the same sort of structure applied here?
Yeah, varies from operator to operator on the consumer facing side, but typically would involve fees and interest.
Yeah. So similar to a credit card in that sense.
Correct.
Like, got to pay on time, otherwise pay a penalty. And then I assume that it's the end road here looks the same too. Like if I don't pay my credit card, I rack up $30,000 on it and then I just stop paying it. The credit card company is going to go to the bank, who's going to go to the executive branch, and they're going to come knocking on my door. Eventually, I would assume that's the case. Is that also like people, at least in the US, I think associate bank and credit card debt with something you just have to pay off. Otherwise, you declare bankruptcy, unless you're like student loan debt category. But many times in companies, it'll be a personal investment. So like if I'm investing in a company and the company doesn't pay me back, well, I just lose. Is the debt that the buy now, pay later companies are issuing, is the debt that the consumers hold, is that if they fail on that, is that, what's the right way to say this? Like enforceable by law versus loss in the books by the companies?
Depends on the jurisdiction, Mike, and will vary a little bit from country to country. I think that general statement is that yes, it will sit on someone's credit file as it would any other loan, and that's part of the challenge of around regulation is helping consumers to better understand that it is that they are taking up finance, and so that there's a ramification if you don't pay it. And so that will be some of the change, and it's been called out in the States and the UK, and probably I would say most likely in Australia in the coming weeks or months. And so there'll be some regulatory change over the next 12, 18 months around it.
Yeah. One more thing I wanted to ask you, you mentioned earlier, that's 62 days. That's the duration of the loan expiration maximum. Is that right?
In Australia, and it works similarly in jurisdictions around the world, is that there tends to be an exemption period that means that it doesn't have to fall into regulated credit. And so therefore the requirements around affordability or serviceability and credit checking and so forth have been a bit easier. So to your point around creating an experience, the genius was that if you could take advantage, and maybe that's not quite the right word, but use the exemption to create a more streamlined way to be able to access the buy now, pay later lending, then it could happen faster, right? So, and hence that loophole, if you like, around the exemption dates, and then the products that are built within that may or may not in different markets around the world be still fit for purpose for what it looks like now, because when that was created, no one had thought of this thing called buy now, pay later.
And do you think the regulations, maybe in Australia, but I'm sure, or I'm getting the sense that they're similar in the States and Europe. Is there too much regulation or not enough?
I would say there's probably not. I mean, specifically within the buy now, pay later sector as it stands right now, there's probably not enough is my personal view on it. We don't, but there has been incredible innovation as a result and a highly competitive landscape. You know, if and this is my personal perspective, if it was over regulated, there is no way a company like Afterpay could have built $30 billion worth of value and, created what they did as a global gorilla. It would have just fallen directly into the hands of traditional consumer finance companies. And so from that perspective, it's been good that it's enabled real innovation in the space. So I would hate to see that regulators around the world came down so hard that then there was no opportunity to go and create new experiences anymore.
And so you think there should be more regulation. Is that to say all the growth and innovation that's happened is somehow taking a toll, or why do you think more is somehow better?
I think more in terms of, and I think, the concept of responsible lending and getting helping the industry to get the right balance between growth at all cost versus protecting consumers. And because, broadly speaking, at this kind of micro lending level for consumers is, banks do it really well. There's a reason why they don't do a lot of micro lending, right? Because it's expensive and troublesome and, so on and so forth. But then on the flip side, you don't want people to just kind of be handing money out to anybody. And that's not what I'm suggesting that organizations are doing. But, some of the things like that you guys have been talking about with open banking and availability of data means we can do smarter cash flow analysis, like things to just help the consumer so they're not kind of, riddled with 7 different types of debt and not understanding it, right? So to me, getting some rules in place around the minimum checks and then using technology to automate that and make smarter decisions, to me, would be good for a loan origination in any context, I think.
Yeah, I tend to have a stance, like personally on this, that by default, no regulation is best. And then regulation, if there's a consistent pattern of the free market failing to solve a problem. And in this case, it seems like if you're a private company, you're Limepay, you're Klarna, you're a buy now, pay later company, you go raise money, you have both operating capital to like build the product and run the business, but then you have loan money that you're going to use to pay the merchants, and then loans that you need to collect for consumers. If you give more money to merchants than you're able to collect from consumers, you run at a loss, and the loss isn't going to be shocking. It's not like, an earthquake is going to hit and you're an insurance company and you insure all the companies down in Los Angeles or all the, buildings. And then all of a sudden you're out that, massive expenditure. It's probably going to more look like a slow drip where you're like, okay, this demographic of people is consistently not paying back or they're slow. And so I would intuitively think that zero regulation is best. Like whatever the 62-day window is, like maybe there's a whole undiscovered market of super long loans, like 30-year loans to buy a mattress. Then maybe that's like, beneficial to some people. I'd be curious to hear your elaboration on why the government has a unique role to play in this market at all.
It's really interesting. There's a couple of things actually. If I just unpack that, one is the laissez-faire capitalist market in and of itself going to work here? Given the kind of macroeconomic situation that everyone's in, maybe it may well be that because some of those operators that you've named, they are losing money hand over fist. They have taken incredible write-downs in valuation. As an example, they can't continue to move from funding milestone to funding milestone, losing and burning cash at the rate they have. So inevitably they do have to tighten the screws and tightening the screws.
Raise, right?
You kind of that like that.
Yeah.
Will that work in and of itself? Maybe.
But wait, can I push back on that a little bit? So if they're losing money, they would make cuts to their, employee count or operating expenses, and then they would raise the rates. But that seems like something that if it doesn't work, you're not out the merchants because, right, you have to pay the merchants up front. So maybe continue on with that. So Yeah.
So it's, we look at it and a lot has been written about the capital markets have been quite scathing in the way they're valuing businesses in this space
Mm.
specifically. And a lot of it is the fact that the business model, not the product, but the business model. And so then I'll bring it back to where government could potentially or should potentially get involved. Is that the product is not the problem, the business model's the problem. To your point, there's default rates, there's the cost of capital, there's the cost to acquire customers, like all of these challenges that are weighing on, the big global guys operating in that consumer facing space, I should say. And they, to your point, that they will have to reduce cost in order to chase down profitability, or at least some, line of sight on profitability at some point. The merchants are very unlikely. You think about traditional e-commerce merchants right now who might be paying somewhere between, let's say on average, 300 bips to 500 bips for the privilege of Mike and Willie bringing this buy now, pay later customer. There's not many merchants in this environment who are going to turn up and go, oh, Mike, your cost of capital went up, so I'm happy to absorb an extra 100 bips or 200 bips. So, a lot of these guys work on 10, 12% EBITDA margin, right? So they don't have
yeah, right.
Hand to you, right? Because there's a cost to each of that. The merchant's funding that. So then you've got downward pricing pressure, cost pressure from your merchants. And then you've got a downward pressure or upwards pressure on the cost of capital. And these two things, I think it sets up what I think is going to happen in the industry over the next 2 or 3 years is that, quite frankly, the most sophisticated consumer and business financing companies who happen to be the biggest retail banks in the world, I think they win, Mike, because they've got the customer. They don't have to acquire Mike. Their lending cost to Mike is cheaper than everybody else. And they're damn sophisticated at managing defaults in a regulated environment. So it's kind of setting up. And then you ask the question, then it comes back to the question, well, if that's just the way it's going to play out, does the government need to get involved from a regulation standpoint, either to protect businesses and or consumers, or to make sure that there is space for everyone to play and innovate still, right? And in my view is it is very nascent, but all of these new financing / payment experiences, I think, the government needs to at least make sure the consumers know exactly what they're signing up for, and or small and or businesses for that matter.
And do you think there's insufficient information dissemination currently from customer to merchant?
I think the short answer to that would be no, because everyone's got a link to a T's and C's page, which is, 7 pages long, right? So it's not that it's probably more broader awareness at the top of the funnel as opposed to detailed information T's and C's, because there's plenty of that stuff around.
And do you see there being a possible scenario where a lot of people get burned somehow? Like I'm thinking about in May of this year in crypto, there was a large centralized exchange called Celsius and a number of other like collateral damage. And it's like a lot of people had their money in these accounts, and then the whole house of cards falls, and now everyone's out all their money. That's like worst case scenario. But here it seems like worst case scenario would be what buy now, pay later companies struggle to make it work. And then is there
because then it's not free anymore.
Right. And
like, hey, God, actually, yeah, I'm probably no is the answer.
No,
because it was a market share play. And so everyone's like, hey, like 24 months ago, and you've been through this so many times in your career, right? Is it when the sun is shining, everyone's like, hey, grow, care about a share. And so at that point, people are like, hey, just give the product for free. And then what will happen is if, as the world gets tighter and harder and cost of capital goes up, is that maybe consumers will wake up one day or businesses will wake up one day and go, oh, there's a fee attached to this and it's fair. And they'll go, oh goodness.
Because right now merchants pay 2.5% for credit cards. So they're used to charging 2.5% higher on all the products they sell to account for that additional expense. It's all baked in, right?
Yep.
I would imagine that just feels like the inevitable process here. Like maybe you pay in cash, or you pay debit transaction electronically, crypto transaction, like you save 3% on your transaction. But if you want this convenience of a credit card or buy now, pay later is less. Yeah. Well, I guess the pushback would be conversion rates go up. Like you're going to sell more couches if you allow people to use a credit card or buy now, pay later. And so you make up the transaction fee and the additional volume.
100%. And that's the way, that's why merchants all around the world have been, some would be more begrudging than others, but most merchants broadly across all sectors have been like, oh, well, I'll absorb it because the incrementality of it has been significant.
And what's your rough guess, or what do you see in the numbers as far as the increase on those transactions? Is it like a 2% bump? I mean, I'm sure there's variation, but you'd agree there is a bump. Yeah.
Yeah, there's definitely a bump. I mean, just the broad, because it varies so much from sector to sector. What I will say is that the bump almost always outweighs the cost implication. And that's why it's grown at its level. Because quite frankly, if it didn't, then, if I were to take away BNPL company X from my checkout, which by the way, Mike, and for the audience here, I mean, if next time you're buying anything online, just check out what we call the checkout spaghetti on any given website, right? Here's my option to 400 different payment. I mean, it's just ludicrous. And I think that has to change.
Yeah.
And so in some ways, consolidation, coming back to this point, is that consolidating the options is going to mean less options means more scale, which hypothetically will mean kind of lower cost potentially for a merchant and or consumers, and small businesses kind of go, okay, to access that capability, I'm willing to pay some money for it. And so, that's got to be the path to profitability for this part of the sector anyway.
What were you, tell me about what you were doing?
So I've been in sort of B2B technology for the last 20 years and have oscillated between startup and big corporates. So in startup, in fact, one of our co-founders, Josh Edis in Limepay, he and I were co-founders in an ad tech business, which way back in 2010 is interesting correlations between what happened in ad tech over the last 20 years and what's happening in fintech today. But we had a data and what was principally a data and analytics business, which we sold to some guys in San Francisco. And so I'd spent some time in the US. I ran Yahoo Search and its advertising, Yahoo Inc.'s advertising businesses in Australia for a few years. And then most recently was with WPP and ran MediaCom, which was, a big communications and advertising agency. So I've, very eclectic set of experiences, I guess.
What's the current theme or general trajectory in online advertising?
I think that data is getting harder to come by, right? And data was costing businesses a lot of money to acquire, but it would get you, more efficiency. And most online advertising, particularly in the big end of town, is optimized within an inch of its life. And one of the things that was really interesting and appealing for me as I joined the board of Limepay back in 2020 was the fact that the payments ecosystem and what the banking and finance industry have in terms of data and online advertising, these two things are like completely disconnected, but there's massive value to be had both ways. Right. And so, I guess part of my vision for what fintech as an industry will see over the next little bit is we can help solve some of those challenges that online advertising is seeing in a respectful way that is compliant, but also, it helps.
No worries.
helps online advertisers to get more value out of their investment.
And where was Limepay when you went from being on the board to joining the company, and where is it now, I guess, in terms of employees or revenue or money raised or however you keep track of it?
Yeah. So in total, we've raised just north of $31 million to date, Mike. I joined after our last big raise, which was in the middle part of 2020. And we've grown to be just shy of 40 headcount right now, mostly domiciled in Australia with some presence in Asia. And in in 2020, in terms of TTV, we will have run less than $40 million through the platform. This year we're on track to do something like $250 million. But the other important thing for us is we've also made a significant strategic pivot, right? So Mike, all of those things that I spoke about, those challenges in the sector around buy now, pay later, we've sort of said our thesis is installment payments will be real, will continue to be real. We believe that B2B installments and cash flow management in B2B is going to be more interesting. You think about my credit card usage in businesses in the States, the fact that 40% of payments or something like that, crazy, in the States are still made with checks.
Is that right?
It's like amazing stat. It's going to blow your mind. 40 or something of that ilk. I'm sure it's dropping every single day now, but there's a digital revolution coming to business in America. And a lot of that is going to be about embedded finance experiences, businesses waking up, and you see this with things like Xero in accounting, right? There's a digitization of that, how they move their money, how they get access to money, like all of this stuff. So we've pivoted and taken our platform to make it easier for banks and FIs to build experiences for those customers.
And so you mentioned 40 to 250 million is the year-over-year change.
That was thousands and thousands of percent.
That's
very young.
Yeah. Well, still, 250 million, it feels like that's high. Is that coming from large transactions? Is it like 250 million? So the average transaction size is north of 1,000 or less?
Yeah, something of that in that sort of range. And, I guess it's still relatively, very, very transparently in the payments game is still, a tiny drop in the ocean, right? In what is trillions and trillions and trillions of dollars. And so, we're proud of what we've done just to prove out the platform. But quite frankly, for us, it's not so much about TTV and what runs through the pipes, and more about deployment of the technology play. Because, ultimately now we see ourselves as an enterprise SaaS business,
right,
as opposed to a payments transaction business. And that's where we think value creation and growth will lie for us over the coming years.
Enterprise SaaS business, as opposed to a straight. So the idea being you're now going B2B to C, as opposed to selling a tool directly to a merchant.
Yep. 100%. 100%.
Yeah, that makes more sense. Interesting. I'm curious to loop back a little bit on the advertising, if you're game.
Of course.
It seems like the majority of online advertising has been through search and social, with Facebook and Instagram and Google search accounting for the majority of it. TikTok obviously changes the game for social. Search is, still majority through Google, but I don't know how long that'll be. Do you feel like things are changing quickly? Like, do you see any tension with the fact that TikTok is Chinese owned and China has clearly and overtly, the government is openly saying we're going to access the back end data of all these companies, or at least have the right to. And then TikTok is wildly successful throughout the world. Is this going to become a major source of tension throughout the world that you anticipate? Because it's going to drive a lot of advertising revenue. It's just the flywheel is just faster and faster and faster. And it's, I'm seeing it. I'm seeing people say don't post on Instagram anymore, post on TikTok. And I've seen the show before, because this is what happened when people, moved from Facebook to Instagram. It was all of a sudden, Facebook buys Instagram and they say they're going to double down on Instagram. And they're like, this app, really? But they see the data that, once you see the trends behind the scenes, you're like, oh yeah, that's the way it's going to go. And it seems like it's going to TikTok, which is just optimized for maximum bandwidth throughput. It's just, faster. And so Instagram spins up Reels, which is a similar type of user interface, but it's slow. It's they're behind the 8 ball on it. I don't know if you have it. What's your sort of take on this? Because it's interesting because it's involved in so many different areas.
Well, I've lived in the online and digital advertising ecosystem long enough, Mike, to have seen a bunch of different cycles, right? And so what you're seeing with TikTok now, is it real? Is it legit? It is, and has the US government made some very, you remember Trump and the concerns around ownership and what's happening with TikTok in order to make it, to allow them to operate around the world. That's not new. Folks in the industry will be very aware that in China, there's no Facebook, there's no Google for the same reasons, right? Worried about kind of being able to siphon US companies being able to siphon data out on the back end to use for whatever purposes, right? But so I think that paradigm is also not new. But you think about Snap and where Snapchat was at a few years ago before TikTok existed. And we do see this kind of trend of, new platforms that will come back. And the question is, what's going to stick? And actually that cycle is probably like a 5 to 7 year cycle. And overall advertising dollars is not changing. In fact, in a recession, it's going to go down.
Right.
And it will go to the places that quite frankly have the best measurement capability. And so the question for me is whether or not it comes out of things like online. So that Netflix is launching an ad funded model. A lot of these guys are all like, hey man, we've got to monetize our content in a slightly different way. So you're going to get a lot more of, that. There's Disney, there's, what cable TV is doing and all of their platforms and video on demand. So what was TV money is going to translate into online video. Who's going to win that? Is TikTok going to take a big chunk? They already are. And then, who gets the big chunks and then who's kind of playing around the periphery. So, and for you guys as a content producer, as an example, how do you get access to that money how do you find that? How do you get the money that would otherwise have gone out to say a radio station and or to Spotify? How do you guys as individual content creators get access to some of that higher up the funnel? Like these are the types of things that people need to be thinking of.
Yeah, I've heard it described. I think Balaji had a take on this, that the social networks are in the early stages of communistic business models, where it's like Twitter, you get 0% of the value you create. YouTube, you get some handouts that is like good enough to survive. Facebook, you get nothing. Instagram, you get nothing. And if any of these platforms want to shut you down and take everything you've owned, everything you've ever made, they'll do it tomorrow. And you say the wrong thing and they'll shut you down and take all your value down in your debt. And so I think this creates a massive amount of pressure to change the underlying structure of property ownership to move it more decentralized. And the tools are now available. Like we can build these decentralized, cryptocurrency keys that have access to your accounts. So I think that will be the thing that comes after TikTok. Will be we'll move to a place, and maybe Twitter integrates it because Elon is, pro innovation and blockchain and everything else. So maybe they move towards that and they open source everything and they open source the algorithm. But unless that happens, as long as these are closed garden, 100% owned, centralized, they'll shut you down if you say the wrong thing. Particularly I think TikTok, many of the large tech companies in social are very woke, and you say they lean heavily left. And I don't know if anyone would debate that. TikTok is also leaning left, but they have now the influence of China. So it's you criticize anything about China on TikTok, they shut you down, or they put you on a blacklist or something. Who I don't know, but they can, and given enough pressure, they will. So I think people will realize that and say, well, we don't even want these companies to have the ability to do that, nor do we need them to. And then post TikTok is decentralized TikTok. So I think when that happens, it doesn't mean you can't advertise. I mean, I don't know how advertising looks, but it probably looks like opt-in, by default, everything's encrypted and private, but I like better ads. I'd rather have a good ad than a shitty ad. So I'll give you my information. I'll tell you how old I am, tell you what I'm interested in. Why not? But I'd rather have it be known what I'm divulging so that I can get good advertising. You probably would appreciate this, but I think great advertising is fantastic. I want to learn what the great pair of men's jeans are so that I can buy them, as opposed to have to go and Google around and search for it proactively. So that's my thought, is just make the data private by default, encrypted, and you own the keys and you opt into the data that you divulge, and in return you get good ad, and you can have total control of that. And it seems in my opinion, GDPR is a total flop total failure because every website now I got to click the cookie thing and I don't really know what it means. And like nothing actually changed except for just a massive transaction tax to the whole internet to click that button. I don't know if you have any reaction to that.
Man, you have opened up a whole can of worms there, but I think you're right. I think the small build on it that I would add to the perspective is that it's how the money flows, right? And you bring it back to like the fintech financial services ecosystem as an example, but in the advertising ecosystem, the money flows from the brand. And the brand is either buying it themselves or they've got an agency. If I'm looking for Mike Townsend and his podcast and that particular audience with a particular flavor of content, it's actually hard to find. And so the big platforms can centralize this and make it so YouTube, as an example, is an easy way to spend your money because they've got all of the capability around helping you to find where Mike and Willie are at. And so if you democratize it, and I love the idea of handing back the keys to a consumer, helping them to understand, and they've got some way to be able to, get proportionate value in that value exchange. I'm giving you my data to use your example because I want 10% off that sexy pair of jeans. That's perfect for me. I think I would be, and I would say that 80%, maybe more consumers would be like, that's totally cool. I'm happy to do that. Then the question is on the other side, if the content itself becomes fragmented, who's going to, is it one organization that goes, oh, there's all this fragmented content. We've got this communistic business model around it. Let's call it, for instance, for argument's sake, communist.ad, right? Mm-hmm. And so communist.ad goes and centralizes all of this stuff. And before you know it, they look just like TikTok or Facebook or whatever, because they're like, I'm giving you one pathway in to buy. I give you all the tools. I set the price. And then it's made out of, it's Willie and Mike, and they all get a slice of the pie in terms of content producers. But I'm still holding all of the keys because the way the money flows is, me as the ad buyer, I can't go and disperse that into a million different buys. I can still only do 5 buys. So then one of those buys happens to be aggregating all of the communist.ad stuff. Communistic.ad, I think that'll be a bit less challenging for people.
Well, is that because to me, it seems like the fault in the structure is that these social media companies have the ability to close your account and shut you down at any given point. And they also have the ability to set rates in the market, meaning rates to advertisers. And they may give you 0% of that, or in YouTube's case, I think they give you like 30%. But either way, it's completely up to them. Now, I could see a scenario where if this was decentralized, that agreement, that pricing structure can be open sourced and decentralized such that no one could change it. So it's like, I go on to, decentralized Twitter, and it's like, well, I get 50% of all advertising revenue, and then 50% goes into the network, which then funds development of the network. And like, no one can change that. It's just part of the source code. And that way I would maybe it's like Twitter, and then do decentralized Twitter and decentralized, next social media app, aggregate data together if you allow that. But you as the user, you'd have permission to say, how far am I willing to let my data be anonymized and go outside the network? Maybe you get a boost in that. You get some like percentage share. Brave is a Chromium browser company, and they built this in the browser natively. So the whole idea was instead of going from brand to publisher, you would go, I want to make sure I get these words right. Brave allows you to go directly to Brave as the aggregated ad platform, and then buy their cryptocurrency, BAT, basic attention tokens, and then use that to distribute your ad on the internet. And then me as a consumer who's just surfing around, I get a percentage of what I'm viewing. So I can click the button to like turn off ads, or I can click turn it on, and then I get a percentage of what the advertisers are paying, which is like, it just wouldn't have been possible before without the technology.
It's super, super interesting. I think it very nascent.
Yeah.
But definitely where it goes over time.
Cause it's my thought is like, whether it's advertising or payments, it seems to me like the distribution of returns is flattening. So where you had massive consolidation around Google or Facebook, now that's becoming flattened. And so members of the community, the users, are being compensated and incentivized. And you start to see that in the fringes with like YouTube doing the ad share. Well, I think they'll all have to do this eventually, where they're actually distributing revenue from the centralized organization down to the members who are creating value. And I would imagine, it's similar in payments, like you have Visa, MasterCard, who take an enormous transaction fee and they go and buy mansions, but they're not relative to the new payment structure potential with decentralization. You could spread that like validation mechanism across many different people and have it be decentralized. And I would imagine, tell me if you disagree, but Visa, MasterCard, how do they survive? How do they, how do they pivot to, play the long game, but how do they survive like decentralized currency transactions?
That's really interesting. Well, I think that my having now played in both ecosystems a bit is that what I'd say is that the underlying rails of what happens in the financial services industry, much harder to deconstruct and disrupt.
Right.
In the advertising if you're a publisher, your ability to access the flow of funds and the advertising payment rails, like you can create new stuff, like you can do it tomorrow, right? It just, do you have enough capital to muscle in on that and kind of get in front of ad buyers and through technology or people? And so the barrier itself it's not the same as the ironclad barriers when you think about a MasterCard or a Visa. And so much of the way money moves around the world right now is, goes on those rails. You can't turn up and go, I'm just going to build new rails and disrupt this. And that's hard. The bit that, we ourselves as a business are very focused on is what is the embedded finance experience, though? The new types of experiences. Now, going back to the beginning of our conversation, where Afterpay created this thing which kind of didn't really exist in a little bit of a loophole, and all of a sudden it was worth $30 billion, because it just delighted consumers. And so if you can do that in a B2B world or in a B2C world, is the battle, it's not really so much a battle for the rails, it's a battle for customer ownership is what we're seeing right now. And so would they disperse that? I don't know, Mike. The biggest, scariest, when you talk to banks all around the world, who are they most afraid of right now? Apple.
Really?
Google.
Yeah. Oh, with Apple Pay and Samsung. Cool.
Yeah, because they own the customer.
Yeah.
And if you own the customer, if they own the customer, they turn around and they go, oh, Mike, actually, what I might do is I was helping you do payment processing over here. And fast forward to 2032, now I'm doing home loans. Oh, by the way, I can give you a credit card. Oh, I can be your crypto wallet. All of a sudden, you're kind of losing relevancy in that conversation, right? So that's, it's no different to on the app publisher side, people kind of going, oh my goodness, who are these TikTok guys? And all of a sudden they're, taking 10%, 20%, 30% from advertising budgets. And so, banks are also thinking through, what does disruption look like there? Does a decentralized money movement or participation, there's got to be a new business model. There's no doubt about that, Mike. So how that's going to work, I'm not sure, but it's worth it.
Well, it's got to be decentralized. I have more of my savings on chain than off chain, and I do more transactions off chain with a credit card, but I would do them on chain if the technology was there. So like let's talk about Limepay. So Limepay, the money that you're collecting from consumers on behalf of the merchants is coming from probably a ACH, what's that tool that connects bank accounts? I don't know, ACH transfer. You could collect money from people's crypto wallets and you could pay merchants in US dollars, which wouldn't be a hard change for the merchants. You'd probably just have that as another payment option. Now, as long as you had the identity of the person, then you could allow crypto payments. And you say, well, what's the benefit of allowing crypto payments? Is there a big demand? I think the answer, this is my thought on it, is today, probably not in developed countries where banking infrastructure is readily available. if and when hyperinflation becomes a reality for the US dollar, then all of a sudden the companies who have the crypto rails already built will be the ones who win. So today people keep their money in a bank account thinking like, oh, the US dollar is going to be fine. But play the story out over 5, 10 plus years, and people have majority of their capital on chain because they want the privacy of it, the security of it. They want to own it, and they want it to not be inflationary. Like, we work with a lot of people down in Argentina, and the vast majority of them prefer to get paid in Bitcoin. They prefer to pay in Bitcoin. They prefer to like live in on chain because, you know, they're experiencing hyperinflation. So I think the opportunity today is like off chain because people just feel comfortable. But oh, the US prints another $15 trillion. Oh, all the Middle East countries stop using US dollars as the global reserve. Oh, like Europe drops the US dollar in favor of Bitcoin as the global reserve. And now it's like everyone's getting out of USD and they're moving on chain. And now they still want to make transactions to buy couches, but they want to pay in Bitcoin or some stable coin. And I think my thought is like, that's where it's going. I don't know the timing on it, maybe 2 years, 5 years, 10 years. But
do you think it'll be like? Do you think it'll be as quick as 2? Because if you do, then I you know, we need to get our skates on in terms of product development, right?
No, I think the pressure here will largely come from people's desire to leave. It'll come from fiat flight. Like, people want to get out of I mean, this is a predictable trend that Ray Dalio writes about, the hedge fund manager who's now like a book writer. And he wrote about the changing world order in his book, which also is like a great YouTube video, which shows like the Roman Empire, the British Empire, the Dutch Empire, the American Empire. They all go through predictable mile markers on the rise and peak and decline of their empires. And inflation is a marker that you're past your prime. Having a wide military base, all, you know, like the Dutch, the British, the Roman, and the American, we all have like a bases on every country in the world. Like, we're way over distributed, way over leveraged, in debt. And now you're competing. Now you lose your moat, right? Like, oh, by the way, all jobs in the whole world just went online and remote. So what does that mean? Like, as of 2 years ago, every American company is trying to hire people abroad. And what's the reaction from the government in the United States is to like clamp down, add more regulations, add more pricing, like raise minimum wages, add all these like barriers to hire people abroad. So now America's workers are less desirable abroad because it's an open market, right? It's like, okay, I don't want to hire American workers. I hire German workers. I hire Australian workers, whatever. So I think this puts like long, even medium term, massive pressure on the American market. And what does the Federal Reserve do to get out of this pressure and get out of their debt? They print more money. And that's when that happens, which is, you could argue it's already started to happen, but when it becomes like, hey, we got to print more money to pay off our debt, that's when everyone's like, I got to get the hell out of here. And where do they go? I mean, Bitcoin's like, come on in, guys. We got this developing, growing ecosystem that's managed by math. And unless we get a solar flare that kills all the electronics in the world, we're going to be around. No one's going to take your money. You own it. And like, value propositions are 10x. So that's my thought. I don't think it'll be 2 years. I think it will be probably 5 plus, but less than 15. And it'll just be the way that people think about it. Like, like prior to credit cards, I remember my grandma would just manage all her money on a checkbook, and she has like, oh, I can't handle these online payments. But like, there was a moment in time where, in the 80s, I think it was, credit cards roll out. Everyone's like, you got to get one. Merchants are like, what the heck is this? And everyone gets one. And now it's just like the network just turns on, and, you don't use, some people use cash to pay, and it'll still be like that, right? You'll still have like remnants of it, but the majority of the market and the excitement is headed in this new direction. That's my take.
Yeah, it's fascinating stuff.
Is there anything else you want to chat about before we jump off either ways?
Man, it's been it's been so much fun to just have to explore so many different things here, Mike. I feel like we could keep going for hours and hours, but I think we'll have to find another time.
Yeah. I want to ask you 2 things. Has there been any books you've read or blogs, YouTube videos that have been particularly inspiring or educational for you?
Great question. Look, I'm a massive Simon Sinek
Oh yeah.
supporter. I think, especially when you think about the pace of change in our industry here, talking about fintech and advertising and so forth, and the fact that we set so many arbitrary goals for ourselves that and become so short-termist that we take things like crypto and its ability to really change the world. We're hamstringing it ourselves because we're worried about the next quarter's results. And so I love the way Sinek kind of talks about what is, if you're playing an infinite game and value creation is true value creation and sustainable growth, we're talking measured in decades as opposed to next quarter, is that it really changes the way we would run our businesses and capitalize things and invest in things and help people and all of that. So I guess that is a massive inspiration to me. And also I particularly agree that, all the technology in the world means nothing if you don't have great humans either designing or deploying said technology. And so, I have always been a big believer that people have got to come first, and see that mistake made all the time. And, you look at how Wall Street views the world, and you kind of go, wow, they think that people and results and success are mutually exclusive, but it's not. It's not. So, especially in this world right now, where the world is so afraid and so nervous about what's happening over the next 12, 24, 36 months in the equity capital markets, now's the time actually to buck that trend and invest in people, and people get us through it.
Would you say you're fearful of the general macroeconomic direction?
I don't think fearful is probably not the right, it's not the right way, not how I would articulate it for myself. I think I'm wary and slightly anxious about what the implications will be like for us and our business and our people. But I'm also old enough to have lived through, the dot-com boom 2 decades ago, and then 2008, of course, and realize that, man, things will come good. It's just a question of whether it's going to be 5 years or 10 years or 15 years. And you just got to take a sense of optimism into that.
And do you feel like China, Ukraine, Russia war, and the general economic backlash from the pandemic, are those the 3 major sources of economic concern, would you say?
100%. I mean, I think the supply, my broad observation is that supply and supply chain issues all around the world, that's going to get better in the next 12 months. If you look at the cost of shipping, as an example, containers, that's almost back to pre-COVID levels. So the ability to move stuff around the world is going to get better. China, fingers crossed, relaxing some of their zero COVID policy, that will make it better again. Manufacturing. So, I think the supply thing is going to fix itself over the next little while. War is, and we definitely don't have enough time for this today, but I'm somewhat of a realist in that, I think that war will come, and that might be a little bit controversial, but war will come. And the question is when, and in many ways it's already being fought right now. Some of it is above ground with missiles, and some of it is on the internet and in technology infrastructure, right? And some of it's in the capital markets. So that's not going to go away soon. And how it plays out, I think, is going to have a material impact on, what you described, the great American dynasty.
Yeah. I saw these stats recently that was the rate at which China is capable of producing physical goods and infrastructure is roughly in the order of 200 times that of the United States. And they measured this by shipping container volume by year. It's I forget the exact numbers, but I think the United States is 70 million cubic feet, and China is in the 400 million. They're just astronomically higher in, and it seems like that advantage of physical, in the physical world, China's just going to win. I mean, they're capable of producing. They produce all the world's goods, for roughly speaking, and I think to go into a head-to-head war, I just hope to God that doesn't happen between U.S. and China on an overt hot war. That would just be, worst case scenario, and something that it should be number one political agenda is to avoid that. You can fight a culture war, that's fine. You fight that one. digital war, oh, I took your cryptocurrency, it sucks, but at least like nuclear bombs are just a whole new level. But yeah, I think a realist attitude is the right one, because if you're on either side, if you're just, head in the sand, ostrich, thinking things are gonna be great, like I get obvious negative externalities from that perspective, possibly even worse than if you're overly pessimistic, but important things to talk about nonetheless. I hope they're not, I hope they become less, I hope they become easier to talk about, and the general temperature of these topics decrease. And I think they decrease more with familiarity and having these conversations. So that's why I always try to bring up the most difficult conversations to have with my guests. So Willie, thanks so much, man. This was a blast.
Great.
I really appreciate you having you on.
Thanks, Mike. It's been fun.
All right. Take care.
Take care.